Welcome to Money Depth Insights. I am the finance guide, John Array. Today we are talking about something that silently drains money from millions of people every single month. Credit card interest. Not the card itself. Not the swipe. Not the purchase. The interest. Most people do not fall into credit card debt because they are careless. They fall into it because they misunderstand how interest actually works. Credit card interest is not loud. It does not announce itself. It does not create panic immediately. It works quietly, consistently, patiently. And by the time people realize what is happening, the trap is already tight. This session will explain exactly how that trap works. Not emotionally, not dramatically, but realistically. Once you understand this, credit cards lose their power to control you. Let us begin. Credit card interest exists for one reason: time. When you use a credit card and do not pay the full balance, you are borrowing time. The bank charges for that time. That charge is interest. This sounds simple, but the danger is hidden in how that interest grows. Credit card interest is not calculated once. It is calculated repeatedly, daily. This means your balance does not just sit there. It moves, even when you do nothing. Interest keeps adding weight to your debt while you sleep. Most people think interest is a monthly event. It is not. It is a daily process that compounds quietly. The first trap begins with minimum payments. Minimum payments feel like relief. They make people feel responsible. They make people feel in control. But minimum payments are not designed to eliminate debt. They are designed to keep debt alive. When you pay only the minimum, most of your payment goes toward interest. Very little touches the actual balance. This creates an illusion of progress. The balance barely moves. But time keeps passing. Interest keeps growing. People stay trapped because they believe they are moving forward. In reality, they are standing still while the ground slowly sinks. Another trap is the way interest rates are presented. A credit card might show an annual percentage rate. That number feels distant. It does not feel urgent. But that annual rate is divided across days and applied constantly. A high interest rate combined with daily compounding is powerful. Not powerful for the borrower, powerful for the lender. This is why small balances can take years to disappear. People underestimate how long repayment actually takes. They look at the balance. They look at the minimum payment. And they assume time will solve it. Time is actually making it worse. The next trap is emotional spending. Credit cards disconnect spending from pain. When you spend cash, you feel loss immediately. When you swipe a card, you feel nothing. This emotional delay encourages spending decisions that would not happen with cash. Small purchases feel harmless. But interest does not care about size. Interest cares about time. Many small balances combined over months become heavy. By the time people notice stress, interest has already built momentum. Another dangerous trap is balance normalization. People slowly adjust to carrying a balance. What once felt uncomfortable becomes normal. What once felt urgent becomes routine. This psychological shift is powerful. When debt feels normal, urgency disappears. When urgency disappears, interest wins. The trap tightens not because of ignorance, but because of emotional adaptation. Credit card companies understand human behavior very well. They design statements to look manageable. They highlight minimum payments. They emphasize convenience. They do not emphasize time. Time is the silent enemy of debt. Interest grows strongest when people delay decisions. Another trap is using new credit to fix old credit. People move balances. They open new cards. They shift debt around. Sometimes this helps temporarily, but behavior does not change. Debt is relocated, not eliminated. Interest resumes as soon as promotional periods end. This creates cycles. Cycles feel like solutions, but they are delays disguised as progress. One of the most damaging beliefs is that paying interest helps your credit score. This is false. Interest does not build trust. Payments do. You can build strong credit without paying interest at all. Paying interest helps banks, not borrowers. This misunderstanding keeps people stuck longer than necessary. Another trap is optimism. People believe future income will solve current debt. They assume promotions, bonuses, better months. But interest grows regardless of future plans. Debt demands action now, not hope later. Optimism delays discipline. Credit card interest also creates stress cycles. Stress causes avoidance. Avoidance causes missed payments. Missed payments increase interest and penalties. The trap becomes emotional as well as financial. Once stress enters the system, clarity leaves. This is why education is powerful. Understanding removes fear. Clarity removes stress. The biggest truth about credit card interest is this: it punishes time without action. The longer balances stay unpaid, the stronger the trap becomes. But the system is predictable. Interest can only trap people who stop paying attention. Awareness weakens the trap. Discipline breaks it. Credit cards are not evil. Interest is not evil. But misunderstanding how interest works is expensive. Once people understand daily compounding, minimum payments, and emotional spending, the trap loses power. Credit becomes a tool again, not a burden. If this explanation helped you see credit cards differently, share your thoughts in the comments. And if you believe this knowledge can help someone in your colleague or friend circle, make sure you share it with them. This video is created for educational purposes only. For more clear, calm, and practical financial education, subscribe to Money Depth Insights. I am the Finance Guide, John Array, and I will see you in the next lesson.